Have you ever wished you had like a real shortcut to being truly well informed, especially with something as complex as investing? What if I told you that sometimes the most profound insights, they don't come from trying to predict the unpredictable future, but actually from looking backward, from understanding how disciplined long-term thinking navigates even the wildest economic storms?
That's exactly the kind of wisdom we're digging into today.
Yeah.
This deep dive, it's an exploration of Giverny Capital's 2016 annual letter to its partners. And believe me, it's far more than just a financial report. It's a profound window into a very distinct long-term investment philosophy, one that really focuses on patience and, deep understanding.
Right. So our mission today is to unpack the key insights, those surprising facts, and the enduring lessons from this specific source material. We want to help you quickly grasp what matters most, going beyond just the numbers to understand the why behind their results. It's really about extracting that enduring wisdom from how they operate. So let's get started. Where do we begin with Giverny?
Okay, yeah, Giverny Capital has a rather humble yet fascinating origin story. It began way back in 1993 with Dill Hildebrand managing a family portfolio. And his approach wasn't just pulled out of thin air, right? It was a careful synthesis of the wisdom from investment legends. Think Warren Buffett, Benjamin Graham, John Templeton, Philip Fisher, Peter Lynch. He really internalized their core principles.
Okay, so he's learning from the masters. And after 5 years of consistently strong results, he decided to formalize this proven strategy, launching Giverny Capital Inc. in 1998 with the goal of offering asset management services that mirrored his own successful philosophy. So this wasn't just a passion, it had a track record.
Exactly. From there, the firm grew thoughtfully. Jean-Philippe Bouchard joined in 2002 and quickly became a partner. Then Nicolas Lequier and Karine Primo in 2005. They even launched a U.S. office in Princeton, New Jersey in 2009, led by Patrick Lichet. What's key, really, is that every new team member genuinely shared the firm's core culture and investment ethos. It wasn't just about expansion.
And this brings us to a really foundational concept for them. We are partners. This isn't just a tagline, is it?
No, not at all. It's fundamental. It means they manage client portfolios exactly as the founder manages his own money. Period. The Rochon Global Portfolio isn't just some benchmark. It serves as the living, breathing model for all their investments.
So when they call their clients partners, they genuinely mean everyone is in the same boat with totally aligned interests. How does that philosophy truly differentiate them in the investment world?
Well, it's fundamental, right? It shapes everything.
Yeah.
From their fee structure, which is performance-based, to the very purpose of this annual letter we're looking at. The letter's main objective isn't just to discuss results. It's to deeply explain the long-term investment philosophy behind their selection process. They want their partners, and really you, the listener, to fully understand why they do what they do, because they believe long-term returns are the direct fruit of this philosophy, not just luck or timing.
And their market view is incredibly insightful, something many investors could probably learn from. They see the stock market in the short term as inherently irrational, unpredictable even. But over the long term, they firmly believe it does adequately reflect the intrinsic value of companies.
That's the core belief. So if your stock selection process is sound, if you pick good companies, the returns will eventually follow. It might take time, but they'll come. It's all about a radical commitment to transparency and comprehensiveness, treating you, the partner, the way they'd want to be treated.
And there's a unique touch to the artwork on the cover.
Yeah, it's a nice tradition.
Mm-hmm.
Illustrating the letter cover with artwork from their corporate collection. For this 2016 letter, it was Dill Hildebrand's piece titled, "This is not what I want, but I want this also." It adds a really distinct, thoughtful tone to what might otherwise be just, a dry financial document.
Okay, let's talk performance. Let's get into the numbers, specifically for 2016.
The Rochon Global Portfolio returned 7.3%, but it underperformed its benchmark by 7.0%. And a chunk of that, 2.8%, was due to Canadian currency fluctuations. That's a notable difference for a single year.
It is, yeah, a noticeable difference. But here's where that long-term perspective becomes so crucial. If we zoom out, their long-term track record is, well, incredibly strong. Since its inception, July 1st, 1993, the Rochon Global Portfolio achieved a compounded annual growth rate of 15.9%. Compare that to 9.2% for its benchmark. That's an annualized outperformance of 6.7%.
Wow, 6.7% annualized outperformance over that long.
Yeah. It resulted in a total return of over 3,000%. 80.3% to be exact, versus the benchmark 686%. Their ambitious objective, which they've largely met, is to maintain a 5% higher annual return than their benchmark over the long haul. Okay, now, specifically for the U.S. portion, the Roshan U.S. portfolio, it returned 7.5% in 2016 versus 12.0% for the S&P 500, so it underperformed by 4.5%. And you mentioned this was its first underperformance since 2007, with 14 out of 20 stocks actually underperforming. That sounds pretty significant.
It does on the surface, but what's truly fascinating here is what they call the rule of three. It's quite something. Over 23 years, the Roshan U.S. portfolio underperformed the S&P 500 on 7 occasions. That's roughly 30% of the time.
So they expect to underperform almost 1 year out of every 3.
Exactly. They expect to underperform indices at least 1 year out of 3 on average. They're explicitly okay with short-term underperformance when their style or their chosen companies are out of favor. This isn't seen as a flaw. It's an anticipated, accepted part of their strategy. It's a revolutionary way to think about investing, isn't it?
It really is. I mean, it takes immense discipline to acknowledge that you'll underperform a third of the time and still stick to your guns.
Wow. Okay, shifting gears geographically, let's look at the Canadian side. In 2016, the Roshan Canada portfolio returned 11.0% versus 21.1% for the S&P TSX, underperforming by 10.1%. But again, the long view. Since its 2007 inception, it delivered 16.9% annualized versus the benchmark's 4.7%. That's a huge added value, 12.2% annually. Why was the specific Canadian portfolio created in the first place?
Well, it was created largely in response to a misperception, actually. There was a belief floating around that Giverny only specialized in the American market, despite the fact they had always held Canadian equities. Their priority is always finding the absolute best companies, regardless of location, which naturally leads to about an 80% U.S. allocation, statistically normal for North American companies.
And it's highly concentrated, right? Just 3 stocks. That's right. MTY Food Group, Constellation Software, and Dollarama. While this concentration makes its performance very different from its benchmark, the Canadian portfolio represents only about 15% of the larger Roshan global portfolio. So their overall diversification requirements are still easily met.
Got it. And 2016 itself was quite a roller coaster for markets, wasn't it? We saw that 13% market correction early on, then the Brexit vote brought another correction, and finally, a dramatic rise after the U.S. presidential election on November 8th, defying a lot of the experts. The S&P 500 gained 12%, the TSX gained 21%. What's the deeper lesson Giverny draws from all that volatility?
Well, if we connect this to the bigger picture, U.S. corporate profits had actually stagnated for a second year in 2016. Growth was flat. But Giverny viewed this sluggishness as temporary. They always look longer term. They point out that since 1993, S&P 500 company profits grew 450%. That's 7.3% annually. Meanwhile, the market itself rose 429%, or 7.2% annually.
So a very direct correlation between market performance and the underlying company performance over the long run. They just track each other.
Exactly. They always come back to the fundamentals. The market eventually catches up to the business reality.
And think about everything that's happened since 1993. All the chaos. 2 recessions, 6 U.S. elections, wars, crises, terrorist attacks, Y2K scares, debt ceiling drama. Yet markets did well because the companies did well. The word despite is absolutely the key word here, isn't it? It's about looking past the noise.
Precisely. Despite all that. And they reflect on lessons from 10 years prior, 2006, 2007. They underperformed then, partly because they avoided natural resources, believing it's hard to have a real competitive advantage there, and also due to a strong Canadian dollar at the time. They highlight that they stayed the course, despite immense pressure to invest in what worked back then, which was similar to the pressure during the tech boom in 1999. Their unwavering lesson. You have to be able to do nothing when everyone else wants you to do something. Following the herd rarely, if ever, works out well.
That leads us perfectly to a truly fundamental aspect of Giverny's approach. They don't evaluate investments by short-term stock price swings. Not at all. They genuinely consider themselves owners of the companies they invest in. So their focus is on studying the growth in what they call owner's earnings and the long-term outlook of the business itself. Can you elaborate on owner's earnings? What exactly is that?
Of course. Yeah, it's a key concept. They famously use a measurement developed by Warren Buffett himself called owner's earnings. It's essentially an estimate of the growth in earnings per share plus the average dividend yield. They believe it's, and this is a great quote, Not exactly precise, but approximately correct.
Hmm.
Echoing that powerful saying, it is better to be roughly right than precisely wrong. It's about capturing the true economic benefit flowing to the owner, not just, accounting profits.
Right, the actual cash an owner could theoretically take out. Okay, so in 2016, the intrinsic value of their companies based on these owners' earnings rose about 9%, while the market value of their portfolio increased roughly 10%. That sounds pretty aligned for that year.
It was quite closely aligned. In fact, it was only the fourth year out of 21 that their market performance so closely followed their company's intrinsic performance. Usually, there's more divergence short term. For the S&P 500 in 2016, earnings growth was weak for the second year running, yet the index performed better than its fundamentals seemed to justify. It seemed to be reflecting hope for future earnings improvement, maybe, illustrating how the market can decouple from reality in the short term.
And yet, over the long term, that correlation holds strong. You mentioned over 21 years, their companies grew intrinsic value by about 1,210%, and their stocks returned 1,266%, almost identical. Their company's intrinsic return was 13.0% annualized versus 13.3% for their stock performance. So the market does eventually reflect fair value.
Precisely. The stock market reflects fair value eventually. It just takes time. And their stocks outperformed the S&P 500 by 5% annually over that period because their companies grew intrinsic values 5% faster. It's a direct connection. It's not magic.
Okay, this raises an important question then. What was the flavor of the day for investors back in 2016? What was the big trend?
According to Giverny, it was index funds. And they had a feeling of déjà vu about it. Apparently, they crowned index funds the flavor of the day way back in 1998, too.
Okay.
Yeah.
So what's their take on index funds? Obviously popular, but what's the Giverny perspective?
Well, they acknowledge the basic principle is legitimate. It makes sense. Most portfolio managers don't beat benchmarks. That's a fact. So for those who can't pick superior companies or superior managers, indexing makes perfect sense. However, and this is the big however, the problem, as they see it, is that passive management isn't truly passive for most individual followers.
What do you mean? How are they not passive?
Well, many act like weather vanes, right? They buy after good years and sell after bad. Or they jump between different styles or fund types based on whatever's recently performed well. Chasing returns, basically.
Okay, and this is where it gets truly shocking, right? The turnover rates.
Yeah, hold on to your hat. The average turnover rate of exchange-traded funds, ETFs, is a staggering 880% per year.
880%. What does that even mean?
It means statistically, the average passive investor apparently holds their ETFs for only about 47 days. And for SPY, the big one linked to the S&P 500, it's even wilder, around 3,000% turnover. That implies an average holding period of just 12 days.
12 days. How is that possible? Isn't that mostly high-frequency traders or something?
Yes, it's absolutely critical to understand that these figures are heavily influenced by high-frequency trading and large institutional flows. They rapidly buy and sell huge blocks of shares. But Giverny's point is that it still underscores how volatile and transactional the so-called passive space has become, even for many individual investors caught up in the churn. It reveals that the ease of trading, combined with behavioral biases, leads people to act frequently, maybe too frequently. And it contrasts so sharply with Giverny Capital's model portfolio, which has a mere 13% turnover rate, meaning they hold stocks for about 2,500 days on average, 7 years or so.
Wow, 12 days versus 2,500 days. That's stark. And this high turnover inevitably hurts returns for the average person, right?
Absolutely. They cite an example. While the SPY index fund itself achieved a 6.9% annual return over a decade, its holders as a whole only achieved 3.5% annually. Nearly half the return simply evaporated into transactional activities. Buying high, selling low, fees, taxes.
And Wall Street just feeds this frenzy.
Wow, yeah, Wall Street capitalizes on what's popular. There were over 6,000 different ETFs then, compared to only about 1,000 a decade earlier. The sheer choice and the ease of transaction, ironically, can make owners more irrational, not less. So Giverny concludes that the problem isn't really the financial product itself, the ETF. It's what they term the self-destructive behavior of investors. Impatience and erratic actions often paradoxically cause that underperformance. It's truly a behavioral challenge more than a market one.
That's a really powerful takeaway, and it's why Giverny Capital embraces learning from mistakes, right? They have this podium of errors. Charlie Munger once said, "I like people admitting they were complete stupid horses' asses. I know I'll perform better if I rub my nose in my mistakes. This is a wonderful trick to learn." That seems to be the spirit here.
Exactly. They use this podium of errors to constructively analyze their biggest mistakes, even if they still made money on the investment. And they specifically note that errors of omission, meaning not buying something you should have, are often more costly than errors of commission, buying something that turns out badly. Let's dig into their 5-year post-mortem of decisions made back in 2011.
Okay, what were the highlights and lowlights from 2011?
On the success side, they acquired Google, now Alphabet, in May 2011. That rose a remarkable 195% versus 65% for the S&P 500 over 5 years. Pretty great. They also wisely increased stakes in Berkshire Hathaway and Wells Fargo during that sharp market correction in the fall of 2011. Those investments rose about 130% each versus 100% for the S&P 500, so definitely some good calls there.
But their missed opportunities sting a bit more, don't they? The errors of omission.
They do. They express regret for not increasing holdings in Bank of the Ozarks, which was up a staggering 420% over that period. Or O'Reilly Automotive, which more than quadrupled. They wish they'd bought more of those instead of just adding to Wells Fargo. Those choices would have yielded considerably better results. It's a good reminder that even the best miss some really big winners sometimes.
And they also revisited a prediction they made. That's unusual for them, right?
Very unusual. Wall Street strategists make predictions constantly, but Giverny rarely does. However, on August 30, 2011, right in the middle of a significant market crisis, the Dow Jones was down 19% from its March highs, remember. S&P had just lowered the U.S. debt rating. European debt issues were flaring up. It was chaos. Amidst all that, Giverny publicly predicted the Dow Jones would climb to 17,000 points within 5 years. It was at 11,280 then.
Bold move in a crisis. And what happened?
Well, 5 years later, on August 30, 2016, the Dow Jones closed at 18,454. So their prediction was correct. They emphasized they only made predictions with a very long time horizon and a wide margin of error. Clearly paid off here.
Okay, now for the official podium of errors from the 2016 letter, let's start with the bronze medal.
The bronze goes to Valeant Pharmaceuticals. They bought Valeant shares back in 2011 at around $45. At the time, it seemed to have a simple business model, few patents, and the 2013 acquisition of Bausch & Lomb looked like a high-quality move.
But there were red flags even then, right? Aggressive accounting, high debt.
Yes, they knew Valeant had more aggressive accounting and higher debt than their usual investments, but they put trust in the CEO, Michael Pearson, and his plan to improve profitability through acquisitions. Roll-ups, basically. They did limit the position size to a maximum of 5% of the portfolio to manage that known risk.
So where did it go wrong? What was the mistake?
The mistake became clearer in early 2015. The Salix acquisition doubled Valeant's already high debt load. That was a big jump. And then a smaller acquisition, Marathon Pharmaceuticals, involved drugs with drastically increased prices. This led to a badly tarnished reputation for Valeant, all for relatively slim financial benefit. Giverny admits they poorly assessed the real impact and blowback from that strategy of hiking drug prices.
How did they handle it?
They trimmed the position in 2013 and 2015 when it exceeded the 5% limit due to price appreciation, and then they fully exited in March 2016 at around $52 per share, specifically because of the increased risk profile they saw. So despite making a roughly 190% return in 5 years, including currency gain, they still classify it as a mistake. Why? Because their confidence in the CEO turned out to be, in their own words, a serious misjudgment. The error wasn't the financial outcome. It was in the process, specifically misjudging management quality under pressure. That's a really key distinction they make.
A tough but crucial lesson about judging management. Okay, silver medal for errors.
The silver goes to Alimentation Couche-Tard, the Canadian convenience store giant. They had actually followed this company since way back in 1993. Initially, laws preventing major food chains from operating evenings or Sundays really benefited convenience stores. When those laws were eventually repealed, many predicted the demise of stores like Couche-Tard. But instead, Couche-Tard ended up consolidating the Canadian market brilliantly.
But Giverny wasn't initially a fan.
No, despite that success, they were never fans of its hyper-competitive gas retailing operations. Just didn't like that part of the business. Yet the stock rose 2,000% from 1993 to 2003. After a major U.S. acquisition in 2003, buying Circle K, they were finally impressed enough by the CEO, Alain Bouchard, to buy a small stake. But then about a year later, they sold it. Really? They admit it was very simplistic. They just didn't like the financial presentation at an investor meeting. This they now call a stupendous mistake.
Stupendous. Okay. Why was it so bad? What did they miss?
Well, since they sold in 2005, the stock climbed nearly another 1,000%. It multiplied over 200 times in total over 23 years, with Alain Bouchard proving to be an absolute maestro of consolidation and operations. This omission mistake, selling too early, not recognizing the long-term genius, has haunted them for over 20 years, they say. Their returns could have been even better had they just translated their clear admiration for the CEO into a sizable long-term investment. It really highlights the potential cost of inaction or selling winners too soon.
Wow, an error of omission haunting them for decades. Okay, finally, the gold medal for errors.
Ah,
This one involves Mohawk Industries in 2008.
yes, Mohawk Industries, the big floor covering company. They discovered it through Peter Lynch initially, and they studied its exceptional CEO, Jeff Lorberbaum, and really admired him. Mohawk, along with Shaw Industries, basically dominates the U.S. flooring industry.
So what was the situation?
In 2007, during the unfolding housing recession, they started buying shares as the stock fell from $102 down to $75. Smart move, seemingly. And it later climbed all the way to $226, yielding a roughly 200% gain or 12% annualized. Looks good on paper.
So where's the golden error in a 200% gain?
The error was about conviction and position sizing. Their initial allocation was only 2% of the portfolio, quite small given their stated admiration. Worse, during the depths of the 2008 financial crisis, the stock absolutely plummeted to a low of $24. It even briefly touched $17 a share. Panic everywhere. At their own annual meeting in November 2008, a partner asked if Mohawk was a bargain at those levels. They replied publicly that it was extremely attractive.
Okay, so they recognized the opportunity.
Yeah. But they admit they did not convert these beautiful words into dollars. They didn't act decisively. They held on to the shares they had, but they didn't add more when the price was in the bargain basement. They calculate that if they had simply doubled their investment then, lowering their average cost to around $50, their return would have jumped to 17% annualized. If they had been really bold and increased the weight to 4% of the portfolio, it would have been over 20% annualized. This was a golden error because they understood the company perfectly, they knew its brilliant management, and they recognized the extraordinarily low valuation. They had all the pieces, saw the market's irrationality, but just didn't capitalize on it as much as they could have. Failure to act on conviction.
That's a painful one. Knowing you're right but not backing it up fully. Okay, let's shift gears a bit. Money is made by sitting, not trading. That quote from Jesse Livermore seems to perfectly capture Giverny's philosophy. Let's briefly highlight a few companies from their portfolio at the time to really illustrate this philosophy in action.
Sounds good. Let's start with Bank of the Ozarks, OZRK. They'd held this one for over 10 years by 2016. It's based in Arkansas, known for its really strong return on assets among small U.S. banks.
What made it stand out so much to them?
Well, the CEO, George Gleason, was apparently legendary. They say he seemed to know almost every loan on the bank's books. Personally. While the major banks got incredibly complex, Bank of the Ozarks just kept a very traditional, disciplined approach to lending, old-school banking. And even though the stock fell 50% during the 2008 crisis, Giverny held on tightly because they believed it was so prudently managed. And the results really speak for themselves. Earnings per share grew from $0.48 in 2006 to $2.62 in 2016. That's 18% annualized growth. Just a fantastic example of backing strong traditional management through thick and thin.
Okay, next up, Alphabet Inc., GOOG, Google's parent, held since 2011. How does a huge tech giant like this fit into their long-term value-oriented approach?
Well, it had an excellent 2016 financially. 21% revenue growth, 18% adjusted EPS growth, strong numbers. But fundamentally, Alphabet possesses an extremely strong competitive advantage, right? I mean, Google literally became a verb. That's a moat. Interestingly, the initial idea to invest actually came from Charlie Munger, who identified Google early on as a company with a wide moat, those durable competitive advantages protecting its profitability. Giverny bought at good prices back in 2011 when Wall Street was actually quite fearful about its difficult transition from PCs to mobile advertising. It shows their willingness to look past those short-term market anxieties to find long-term value, even in tech.
Makes sense. How about CarMax, KMX? Held since 2007. They really shook up the used car industry, didn't they?
They absolutely did. Revolutionized it by bringing integrity, honesty, and transparency to a business that often lacked it. Its brand really became synonymous with reliability, which is pretty rare in that sector. They even share a little anecdote about a friend selling his car there and getting a check in just 10 minutes, a testament to their efficiency and straightforward process. The stock was quite volatile in 2016, dropping from $74 down to under $45 at one point. That actually allowed Giverny to increase their investment. which showcases their strategy of adding to positions in quality companies during market dips when others might be panicking.
Let's touch on Constellation Software, CSUT, Toronto-based software company.
Yeah, Constellation Software had over 15% revenue growth in 2016, mostly fueled by smart acquisitions.
Mm.
The CEO, Mark Leonard, has described the letter as exceptional, but also extremely low-key and discreet. Not your typical high-profile tech CEO. They clearly value that substance over style.
Okay, and what about a household name like Walt Disney, DIS? You mentioned 2016 was actually a tough year for Disney, numbers-wise.
It was, yeah, a bit mixed. While his film division had a spectacular year, think Star Wars, The Force Awakens, Finding Dory, Captain America, Civil War, Zootopia, just monster hits. But its television revenue, especially from ESPN, saw declines. That was due to rising sports licensing costs and falling cable subscriber numbers, the cord-cutting trend starting to bite. However, Giverny's view was, and remains, that the core of Disney is its unparalleled library of family-friendly films and its irreplaceable amusement parks. They believe those core assets will offset the TV declines over the long run. It shows their conviction in the enduring power of core assets and long-term trends over short-term segment challenges.
Makes sense. How about Dollarama, DOLT in Canada?
Dollarama. Held for almost 7 years by 2016 and consistently exceeding expectations. Sales increased 12% that year, and crucial same-store sales grew nearly 6%. Very strong performance. And importantly, the founder, Larry Rossi, had recently transferred CEO duties to his son, Neil. Giverny saw this as ensuring the company's unique culture remains embedded in its DNA. Continuity of culture is key for them.
Interesting. And Heiko, HEIA, acquired in 2016. What's their story?
ICO's aviation division sells alternative aircraft equipment, think PMA parts, replacements for OEM parts. It's a market with incredibly high barriers to entry. You need FAA approval, an extensive parts catalog. It's complex. This provides Heiko with a very significant competitive advantage. And the track record. EPS grew 19% annually over the prior decade. Checks all the boxes for Giverny.
Okay, a couple more. LKQ Corp. LKQ, similar space to Heiko.
Similar in that it deals with alternative parts, but for cars. LKQ specializes in distributing alternative car parts recycled, aftermarket, remanufactured. They had a good 2016, expanding in Europe and making a major U.S. acquisition, Pittsburgh Glassworks. Giverny notes they've done an excellent job of consolidating this fragmented industry. Another example of liking strong operators in niche markets.
And O'Reilly Automotive, O-R-L-A, held since 2004.
Yes, O'Reilly, the auto parts retailer. Another long-term winner for them, consistently defying even optimistic expectations. EPS grew 17% in 2016. That marked the 8th consecutive year of more than 15% EPS growth. Just incredible consistency. Their only regret, mentioned in the letter, reducing their allocation to O'Reilly over the years as it grew. Another potential error of omission, selling a winner down.
Visa.
Yeah.
Seems like an obvious quality company now, but when did they buy?
They bought Visa back in 2010. At that time, there were significant fears swirling about potential legislative overhaul on credit card fees, Dodd-Frank, and all that. Those fears created what Giverny saw as an excellent price opportunity for this truly dominant company, a classic case of buying quality amidst short-term uncertainty. And the stock price. It had increased fivefold since their purchase by the time of this letter.
Finally, Wells Fargo, WFC. 2016 was a notoriously tough year for them, right? The fake account scandal.
Yes. 2016 was very difficult for Wells Fargo. That scandal erupted, where advisors were found to have opened millions of unauthorized accounts just to meet aggressive sales targets. Unacceptable practice, as Giverny notes. Management acted fired culprits, paid hefty fines, and CEO John Stump eventually retired under pressure. Despite these major challenges, the company managed to maintain its core customer base, surprisingly resilient. Giverny believed the worst was behind them, especially looking ahead to potentially reduced bank regulation and the prospect of rising interest rates, which generally help bank profitability. They saw it as navigating a crisis in an otherwise strong franchise.
So looking across all these examples, what's really consistent, despite the individual company challenges or the market volatility, it's how they all reflect that core Giverny philosophy. Find strong companies with durable competitive advantages and exceptional management, and then just sit tight. Let them compound.
They absolutely do. It comes back again and again to that core belief that the market eventually reflects the fair value of great businesses. You just need the patience to let it happen.
So what does this all mean for you, our listener, wrapping this up? This deep dive into Giverny Capital's 2016 letter really reveals a remarkably consistent, disciplined investment philosophy. It's rooted in long-term thinking, patience, and a really deep understanding of the underlying businesses. It's truly about being partners with strong companies, not just betting on short-term market fluctuations or, political whims.
Yeah, and we've seen how even experienced, highly successful investors like Giverny make errors. And interestingly, not always in losing money. Often the biggest errors were in failing to act decisively on their deepest convictions, those errors of omission we talked about. And given that they conclude, the biggest problem for most investors isn't the financial product itself, but their own self-destructive behavior, that impatience and willy-nilly action. Maybe consider this. How might truly understanding your own behavioral tendencies, not just market trends or company fundamentals, be the ultimate competitive advantage in navigating whatever uncertainties the future holds for your own financial journey?
No, that's a fantastic point to ponder. We really encourage you to reflect on how you can apply these principles. Patience, deep understanding, and crucially, an awareness of your own behavioral biases. Apply them to your decisions, whether in investing or, frankly, other aspects of life too. Thank you so much for joining us on this deep dive.